Will these energy ETFs soar or crash? Let's find out. First off, read this disclaimer carefully. We will look at three very interesting ETFs. We have the XLE, which is the Energy Select Sector Spider Fund. And we will look at two leveraged alternatives. You have the Direction Daily Energy Bull, if you are bullish, 2x, and you have the bearish alternative. So the ERX and ERY. Here is the XLE with weekly data points. You can see that there's been a devastating crash. You have to go all the way back here to well, you actually have to go the way 2003 to find these low levels. Absolutely shocking what we are seeing in this space. And bear in mind that this ETF is reflective of a huge part of the entire industry. This opens up very interesting opportunities. In this energy space, this is where we will see huge rallies, but also huge crashes, because that is what happens when you have these big moves. There's a big spike in volatility, huge uncertainty, and this opens up great opportunities for active traders. From a purely technical standpoint, we have had an absolutely devastating crash. If we measure here from this high to this low here, 76% plunge. The recent move is to a large extent the result of the virus situation, meaning there is a very low demand. Beyond that, we also have a trade war when it comes to oil. Hence, we are talking about multiple factors. On top of that, you also have the very problematic long-term situation for fossil fuels. This is a hated industry. That is problematic. Long-term, I am extremely bearish on fossil fuels, but there will be huge tradable opportunities every now and then. The correlation here with the S&P 500 is minus 10-ish%. You can see that we are below all the key moving averages. If we zoom in, there is some improvement here, for the bulls. You see that the 5-week moving average, it was a resistance level. It is currently a support level. It will be very interesting to see whether this level breaks. If it breaks, then we will go down significantly. But yeah, let's just see what happens, because the bulls, they desperately want to protect this level. A break below that could really accelerate the selling. Another issue for the bulls, that is this pink-ish 10-week moving average, a solid resistance level. We are relatively oversold, hence you could make the contrarian case that we are due for some bounce. A lot of the bad news are priced in. If you look at the daily data points, these longer term moving averages, the 200-day, 150-day, are very negative. That's very bearish. But you see that there is some constructive developments here. If we measure from that low to our current level, that is 39%. That's decent, especially if you were to use some of these leveraged products. There is an overall rising trend here, and that's notwithstanding the devastating news we had yesterday. Total oil apocalypse. It is a bit different in the sense that this happened to the May futures contract, and this is basically how futures work. You have these contracts and you need to roll over to yeah, the next month. Yeah, it's just a very different beast than an ETF. Still, it is extremely disturbing to see a future contract go into negative territory. That is not something that happens, and it is a testament to the deep sickness in this space. So from a technical standpoint, there is some constructive developments here in favor of the bulls, but there are some absolutely critical levels they need to protect. The 20-day moving average here in purple needs to hold. If we see a break below that, then the bears will start to get feisty. Yeah, so that's some of the technicals. Let's now look at these leveraged products. You have the ERX. That's if you are bullish. So let's look at the ERX, and we can here in the background have the XLE, which we just looked at. Here in purple, maybe we should have a bit more sharper color. Let's have a vibrant pink like that. So in pink here is the XLE that we just looked at. The ERX, that is the leveraged 2x bull ETF. Let's also get some statistical correlations here. Let's have the XLE like that. You can see that there is a minus 94% negative. No, okay. Not negative, but positive, okay. So 94% positive correlation between the ERX 2x bull ETF from Direxion and the XLE. Ideally, we would want to see a 100% positive correlation, because these are supposed to move 1-to-1. We don't have that in this case. But 94% is decent. It means that they more or less move together. So this is an alternative way to to get more leverage if you are a bull. Let's look at some of the recent developments here from the recent lows. Okay, let's zoom in a bit like that. So from here, from that low to that high, that's 111%. That is pretty decent. It's pretty decent indeed. So the bull 2x is an alternative. If you are a bear, then you have the ERY. Here again, we do have in this pink, that's the XLE. The correlation here is minus 85%. Negative correlation, that is, between the ERY, the bear 2x shares, and the XLE. Ideally, we would like to see a minus 100% correlation, because these are supposed to move opposite each other. This, this correlation is a testament to the tracking errors that we see in these leveraged products. This is why you have to be careful. If you are going to use leveraged ETFs, you need to watch them very closely. If you look at some of the most recent moves when there was this crash in the XLE, like if we measure from this low to that high, that's 641% move. And that was in a very short time frame. Let's actually measure the time frame. That was 28 days. That's decent for a month. It doesn't make a whole lot of sense to look at moving averages when it comes to these kinds of products, because it's all about the underlying thing. The thing is that if you are going to trade products like this, the leverage products that is, then you need to just watch them very, very closely. There are alternative ways to trade the XLE and get leveraged without resorting to these two ETFs. And that is by going into the options market. Here is Yahoo Finance. And if we go here and look at the options contracts, if we look at the May 15th contracts, then you can see that there is a decent open interest here on the puts and the calls, up into the 4 digits here. So the options market is really fantastic for the XLE. You can see that this is a very liquid ETF. The average daily dollar volume is 1.4 billion US dollars, huge liquidity. Assets under management is 7.76 billion US dollars. A 94 rating here from at ETF.com. Let's look at some of the companies. So you have Chevron, ExxonMobil, ConocoPhillips, Philips, the big names basically. Let's have a short educational segment about inverse ETFs. A bit of an introduction here. So the thing about these ETFs is that the ETF performance is inverse opposite of the underlying index. In this specific example, you have the S&P 500 and represented with the SPY ETF. And if the SPY ETF falls minus 2%, then the SH price should rise by plus 2%. That assumes that there is a perfect, as close to as perfect negative correlation between the two. They should move opposite each other. Something we did see with the XLE and the ERY and the ERX is that the correlation was, they were strong but not as good as we want them to be. Meaning we saw some tracking errors. When it comes to ETFs, there are unleveraged and leveraged alternatives. SH, as an example, is an unleveraged, short, bearish take on the SPY. So why use these ETFs? One thing is that they enable you to make money on a decline, which is especially useful in these times when there is tremendous volatility in both directions. This is a different kind of market. It's not like back in the day when you had a nice bull market and everything just goes up and you can buy the dip. This is a time when you need to have a much more balanced and preferably market neutral approach to the market. With the inverse ETFs, the barrier of entry is very low, much easier to approach than the options market, as an example. And leveraged ETFs offer potential for big gains, which we saw in the ETFs. I mean, there were some huge moves recently. There are many reasons why you should be careful. These ETFs are deceptively simple. They are certainly less sophisticated than the options market, but then again, due to the tracking errors, they are actually more complicated than you might think. Hence, you should definitively watch them very carefully if you have them in your portfolio. They are not intended for long-term holding because the performance can diverge from underlying index over time, and the extent of these divergences, it varies substantially. There are actually some leveraged ETFs that have been able to track the underlying index over significant time periods. Others have been the polar opposite and been a disaster for long-term holding. We are talking about leveraged ETFs that are literally down minus 99% within like a couple months. That is pretty substantial. So these ETFs are only for people actively following and managing their portfolios, and you can consider these inverse leveraged ETFs as the habaneros in your portfolio. They give you that extra spice, but you need to be really careful about dosage. These are definitively very exciting times in the energy space, for sure. There will be tremendous bullish opportunities, huge bearish opportunities. However, the big picture, if we go like, from space, the huge picture of the energy market, especially when we talk about fossil fuels, it's almost impossible to be bullish long term. the trend is completely against fossil fuels. Clean energies are rising, and fossil fuels are not simply in a downtrend, they are actually hated. I mean, it's just amazing to see how the winds have turned against fossil. Whatever you do with these products, you want to let the trend be your friend. We have seen some very interesting levels to watch going forward. The coming days will be incredibly important because the levels that we found, something will happen with those levels, and that will have huge ramifications, whether the potential is to the upside or the downside.